Hey there, and welcome to the very first episode of Stardust Talks Crypto. We're your hosts, Adit and Theresa, and in this episode, we're going to explain why crypto exchange fees are over 50 times higher than traditional exchange fees. So here are our Stardust profiles, which summarize all of our fees and returns. For every $100,000 I have invested, I'm paying almost $3,000 in fees compared to Adit's almost $800. Now compare these fees to a Vanguard ETF, which would only cost you around $50. So my crypto portfolio is 73 times as expensive. These fees are why Coinbase was worth more than the top 3 traditional exchanges combined when it recently went public. In this episode, we're going to break down how these cryptocurrency exchanges work and why their fees are so high.
Let's start by taking a look at traditional financial securities. Say I want to purchase one share of Amazon stock. Well, in order to buy it, I'll need to go through a brokerage. In this case, let's use Charles Schwab, but it could just as easily be a Robinhood or a Fidelity. I enter a trade with my broker for one share of Amazon and now they need to go fill it. But how exactly does that happen in practice? You might think that they submit your order to the NASDAQ or New York Stock Exchange and then that exchange just immediately fills the order. In reality though, exchanges function like a two-sided auction house where buyers and sellers are constantly bidding to have their trades executed. Buyers and sellers have their own price and the job of the exchange is to help negotiate the price and facilitate the most trades at the most agreeable prices to the most parties. Here's an example of an exchange facilitating price discovery. You can see the prices moving to best match the buyers and the sellers. Here, the sellers are in red and the buyers are in green. There is a bit of a price difference you'll notice between the highest price someone is willing to buy at, called the bid, and the lowest price someone is willing to sell at, called the ask. This price difference is called the spread. Healthy exchanges with lots of volumes have tight spreads, which means there isn't a big difference in price between the bid and the ask. But an exchange isn't the only place where a broker can buy or sell securities. In fact, they don't even have to fill your order using an exchange at all. There are dozens of places where they can go to fill your order. These different routes all have their own unique pros and cons, as well as their own prices. Ultimately, for us, we want our broker to choose the cheapest price for our one share of Amazon stock since we're buying. How does a broker ultimately choose where to route your order?
Well, that's where the SEC steps in. Regulations mandate that all broker-dealers provide their customers with the best execution they possibly can, but best execution is loosely defined. In effect, for the brokerages, this has meant that they need to beat or match the national best bid and offer price, which is the best publicly available price for a security. However, outside of that requirement, they have broad latitude to route your order wherever they wish. Now, back to our example order. Let's say the MBBO is 1905. That means that the broker can't route that order to ECN, but they still have 3 options to fill it. Now, you'd want them to pick the exchange as it has the lowest price. But remember, best is open to interpretation. But unfortunately, it's also open to bribes. The industry calls them kickbacks, and you've probably heard of this process referred to as payment for order flow. Essentially, the market maker can bid in this case to have the order routed to them over the exchange, meaning that our order isn't going to execute at 1902. It's going to execute at 1905. So let's take a look at how they actually route orders. Here we've chosen 3 brokers to show you how and where they route them. These 3 all route less than 1% of their trades to the exchanges. The bulk of all orders these days go to a few big market makers. You've probably heard of Citadel, but there are a few other big players in the space such as Virtu Americas, G1, UBS, and 2 Sigma. So let's talk about why that is.
The reason we chose these 3 brokers is because they all approach payment for order flow very differently. Fidelity doesn't participate, but they, like everyone else, has to pay to execute a transaction on the exchange. So even though they don't participate in payment for order flow, they still try to avoid these exchange fees generally. Schwab is a flat structure to avoid any conflicts of interest, but since the exchange charges them too, they generally avoid it as well. Robinhood has a wide band of payment for order flow rebates and receives much higher rebates overall. We should say for the record, according to Robinhood's official statements, that these rebates don't have an impact on how they route orders. But you're probably wondering why you should care. Order execution really impacts you when you file a trade. Remember that brokers have to just meet the NBBO price, and in 95% of cases for Robinhood and 99% of cases for Schwab, they either meet or beat that price. Beating the NBBO price is the important part. Brokers often beat it and by quite a margin. As an example, if in January you decided to trade 100 shares on Schwab over Robinhood, you would have saved yourself $2.76, and that's on every 100 shares you trade. It doesn't sound like a large difference, but it really adds up over time, especially for active traders with large portfolios.
Now, let's head on back to crypto. Similar idea this time, but I want to buy 1 Bitcoin instead of 1 share of Amazon. So I log into my crypto exchange account, in this case, let's just say it's Coinbase, and place my buy order. So it's Coinbase, the exchange itself, that needs to fill my order. Now, if this was traditional finance, Coinbase would be forced to play the role of broker and look at all the exchanges to secure us the best price, which in this case would be Bitflyer. In fact, this would be really helpful as prices can significantly vary across the exchanges. Add in the complication of spreads and exchange fees, and it starts to make a whole lot of sense how a broker can help you execute your order quickly and at the best price with the lowest fees. But crypto lacks best execution requirements, which means Coinbase always wins, even if there is a better offer out there, which means you are basically never getting the best price when it comes to crypto.
And since none of the exchanges need to source the best prices, it allows them to lock you onto their platforms and keep their margin high since there's no competitive pressure. That's why they can charge you all the same high transaction fee. If we're to compare to something like Robinhood, which has to compete with the traditional brokers and route orders according to best execution requirements, you can really see the impact competition makes. Of course, Robinhood still makes its money from routing your crypto orders to third-party market makers and through an artificial spread. Since crypto is unregulated, Robinhood can look at all of the different exchanges, charge you the highest price, but then ultimately execute for the lowest price and pocket the difference. If you include that artificial spread, Robinhood's pricing is competitive with the pro platforms of the larger crypto exchanges.
Ultimately, the lack of best execution protection means that crypto portfolios, for the moment, have much higher effective fees. We'll probably see exchange fees start to reduce as more investors in crypto push for better execution and transparency. Thanks for joining us this episode. We really hope you enjoyed, and we'll see you next time where we find and break down all crypto exchange fees.